American markets experienced a shock that immediately changed investor sentiment. A single report from the U.S. labor market was enough to cause key indices to reverse sharply and wipe out several days of growth in a single day. The figures show that the labor market is beginning to cool unexpectedly quickly. According to the latest data, companies are cutting thousands of jobs a week, and the number of new applications for unemployment benefits has jumped to its highest level since the beginning of the year. A weakening labor market is one of the most reliable indicators of a slowing economy. When companies cut back on hiring and lay off employees, it is clear evidence of declining demand. The indices reacted immediately. Growth technology stocks fell sharply, and bond yields plummeted. These statistics may indicate that the U.S. economy is running out of steam after years of extreme resilience. The latest statistics from the U.S. labor market exceeded analysts' expectations and literally shocked investors. The weekly number of new jobless claims fell by 6,000 to 216,000, the lowest level in 7 months. The market had expected an increase to around 225,000 new claims. In other words, Americans are filing for unemployment benefits less than expected. Layoffs remain minimal. This is confirmed by economist Carl Weinberg's comment. These numbers do not indicate a wave of layoffs. For the Fed, they send a message that there is no reason to rush to cut rates in December. At the same time, however, the labor market is beginning to show some signs of cooling on the labor demand side. The number of people receiving benefits for more than 1 week rose by 7,000 to 1.96 million. This indicator has risen for several weeks in a row, indicating that the unemployed are now taking longer to find new jobs. In other words, although the pace of layoffs remains low, vacancies are being filled more slowly, which may signal a gradual easing of the extreme tension in the labor market. Another important figure is the unemployment rate itself. In September, it rose to 4.4%, the highest level in 4 years. In the summer, unemployment was still around 3.8%, and a year ago, it reached a 50-year low of around 3.5%. However, unemployment of around 4 to 4.5% is still very low from a historical perspective. Investors also paid close attention to the monthly statistics on job growth, excluding agriculture. Due to the recent 6-week government shutdown, the publication of the data was delayed, so the figures for September were only released in November, and the results significantly exceeded expectations. In September, the U.S. economy created 119,000 new jobs, which is less than last year's average, but more than expected and more than the average of around 100,000 per month in the first half of 2025. Despite some weakening, the U.S. labor market therefore remains relatively strong. Of course, all investors on Bulios are watching this in the flash news, because even large companies such as Amazon and Verizon have announced layoffs of thousands of people. And in the case of Verizon, this has generated a positive response from investors, because the company will save millions of dollars thanks to the high costs. Why exactly did the good news from the labor market cause a shock and a drop in stock prices? The answer to this question lies in expectations regarding Fed policy and interest rates. Until recently, the prevailing view in the markets was that inflation was on the decline, and the economy was slowing down, which would allow the Federal Reserve to cut rates again. This belief was fueled by a series of favorable macroeconomic data. For example, U.S. retail sales slowed significantly in September after 3 months of strong growth, and consumer confidence fell to its second lowest level in 5 years. Inflation also showed signs of easing. This combination suggested that both the economy and inflation were cooling, which increased bets that the Fed would preemptively cut its benchmark interest rate at its meeting on December 9th through 10th. However, new data from the labor market has significantly dampened this hope. It is also worth mentioning that immediately after the publication of these surprising figures, the market reaction was mixed. Paradoxically, the probability of the Fed cutting rates in December initially increased. Some forecast models showed an increase in the chance of a December rate cut from 33% to 43%. For the sake of completeness, let us add that the Fed has already begun to cautiously lower rates in recent months. Bankers have cut interest rates by 0.25 percentage point at the last 2 meetings. The current situation, where positive macroeconomic news causes panic on the stock market, may seem strange. However, this is not the first time that markets have faced a similar paradox. History offers several examples where a strong labor market and low unemployment have led to fears of monetary policy tightening and caused stock prices to fall. Investors who are up to date thanks to Bulios know that one of the hardest hit stocks was Nvidia, which fell by more than 6%, despite the good results it announced just a few hours before the slump. One recent case is 2022. At that time, U.S. unemployment fell to 3.5%, the lowest in 50 years, which under normal circumstances would have been a positive signal for stocks. However, in 2022, the economy was plagued by high inflation, and the Fed responded with aggressive interest rate hikes. Despite record low unemployment, the stock market weakened significantly in 2022. We experienced a similar situation earlier in early 2018. At that time, unemployment was around 4.1%, the lowest in 17 years. However, February 2018 saw a sharp sell-off. One of the triggers was a report of strong wage growth and continued job creation, which the markets interpreted as meaning that the Fed might have to raise rates more quickly. The S&P 500 index fell 11% in 2 weeks at that time. Some big players on Wall Street are even warning that after a long period of growth, a healthy correction of around 10% in the coming months cannot be ruled out. On the other hand, it is important to keep in mind your investment horizon. If you are investing for the long term, markets always grow. All previous declines, caused not only by these data, have always paid off in the long run, and markets have continued to grow. If you are looking for stocks that could beat the market in the coming years and grow much faster than the indices, take a look at Bulios. Here you will get a perfect overview of how each company is performing. You can find out its fair price, look at its quarterly results, or ask for an analysis from our stockbot. And if that's not enough, you can filter stocks according to your exact requirements and find out which companies are doing best. And that's not all. So what are you waiting for? Check out the description, where you'll find a 10% discount on membership, and pick stocks like the pros.